How's it going, fellow traders? It's Magic Trader here, and this is the CFTC report that was recorded on April 3rd, 2018. Here's a snapshot of the data of the institutions for the US dollar and all the major pairs. And so let's take a look at gold. So what do we see here with gold? All right. So last week we had highs of 259,000 positions, okay? Now I've been mentioning that, every time the institutions get to these highs, they're taking profits on longs, right? So we had a drive up in price right here. So of course they have to increase long positions to get price up there, and then once we get up there, they close off those long positions from 259 to 234,000. So let's take a look here, right? If we go back to January when price hit these highs, what did we have? We had positions of 305,000 positions, 305,000 contracts. Okay, so price gets up, 305,000 contracts down, push back up, close more longs. You see the aggressiveness here? Close more longs, drives price down, push back up 259, and then boom, close them down to 234. All right, so the last time price positions were down at these lows was right here on March 20th, 3 weeks past, which was down in this area at 223,000. So we can obviously see that longs are being closed off. All right, longs are being closed off as they keep on pushing price up at these highs. We're going to take a look at the other pairs, and we're going to see something similar happening on those other pairs. But bottom line is longs are being closed off, and shorts were aggressive at that point when price got up here, and then you've seen them closing them off as price dropped. So opening up shorts at the highs, profiting on those shorts when price drops. And what do we have now as price was dropping here? We have 234,000 longs and 68,000 shorts. So shorts are basically very cooled off at this point. Shorts are very cooled off, and long exposure sitting at 78%. Bottom line is, if you look at the coloration of the cells, they are blue, which is neutral, which means we should not be trading gold right now, because even though there is a slight advantage to price dropping because of the expected strength in the US dollar, even though that's a higher probability, it's still not a good chart to trade. Okay, yes, it can go down, but I mean, the likelihood of that happening, is greater than price moving up. But there's nowhere to take a trade off of. There's no zones to take a trade off of. There's a lot of ranging, and when price is ranging up and down like this is not a good time to trade. Like I said, I'd like for price to get down here, and then I'll be taking longs all day, but waiting for that drop to happen first. Okay. So take a look at oil. Let's see. We had pretty much a similar situation back at these highs, 866,000, and then taking profits on longs, causing price to drop right down into this area. So once price got down there, they started filling in those longs again, right? 823, 854. And then we have consolidation here, and what do we see? They're closing off those longs again. So building up longs, closing longs, building up longs again, closing longs, and now we're on the way down. We see that price has dropped since this candle of consolidation here, and longs have dropped 854 to 829. At the same time, shorts are dropping. So bottom line is that we're still overexposed here on longs, 86%, which is very high. And net positions dropped slightly from positive 715 to a positive 699. So I've opened up a long position with this drop in price here, But like I had mentioned, it is a risky position. The reason why it's risky is because the institution's already overly exposed to the long side. All right, they're overly exposed to the long side, and yes, we do see them taking profits on longs. But the reason why I took this trade is because of, some market dynamics that are in play right now, suggesting that the trade that I took has a good probability of working out. Now, the zone that I took the trade off of, it is a higher risk zone. My original trade setup is to take a trade off of a daily demand zone, which is a higher probability trade than the one that I took. But I took it because, again, my rules suggest that that was a good area to take a trade, because there is, it is, number one, an institutional zone that could eventually work out in my favor very well, because it's a 4-hour zone. My risk was, my position size was fairly large based on the amount of risk that I take on those type of zones. So the reward can be really good for me. So I took the trade. So we'll see how it plays out for the rest of the week. But again, we do see some profit taking at these highs, just like we see with gold. So so it is risky. Again, 86%. But open up the trade. We'll see how that plays out this week. Okay, so the US dollar, what do we see with the US dollar? We see that longs closed off from 24,000 to 21,000. Okay, as we got a push up right here. That candle right there. We got a push up from that tested weekly area of demand, and the shorts get reduced from 26,000 to 23. Okay, now just like in the gold, and we're going to see in the euro, when price first got down here at the weekly area, their short positions were 35,000. Okay, so then price comes up, and the next time it gets down to that area, they're 26,000. Same price, but exposure has been reduced on the short side. Okay, exposure has been reduced 35,000 to 26,000. That's a huge drop. But if you take a look at the balance, how they're keeping and maintaining balance here, take a look here. 53% over here, 51%. Look at this drop from 34,000, 35,000 to 26,000. That's a significant drop in positions. But the reason why we don't see such a significant move from these areas is because they're maintaining balance. And how are they doing that? Well, because they're also reducing their long exposure. Okay, which helps to maintain. They're not adding heavily to longs because they want to maintain price at these lows. Okay, so this is a more advanced topic that we will eventually get into when we start doing the webinars, and I have plans to start doing them next weekend. So this will be an advanced topic that we will eventually get into. Basically, it's going to be explaining how the institutions manipulate the markets and how they artificially keep price at a specific area so that they can use that manipulation to keep price at those areas to their benefit. And what we see here is what used to be aggressively short is now becoming less aggressive. Profit taking on short positions down at the lows that they want to be taking those profits at. Okay, so it's pretty brilliant stuff, and it's taken me years to see how they do this and to figure out how they're doing it. And I've seen this numerous times, but it has taken me quite a long time to even notice it. Okay, it's just fairly recently that I started to notice it, and I made mention about this on Twitter a few weeks back because I was noticing the same thing happening with the euro. Okay, so for years I've been studying these charts, for years I've been doing the COT reports, but it's only recently that I noticed how they artificially maintain price at a specific level so that they can offload positions. All right. So again, it's just brilliant stuff. So let's go on to the Aussie. What do we see with the Aussie? So this one's a little bit peculiar because I'm expecting a move to the upside, right? Because market dynamics suggests that this is a weekly area of demand where the institutions will more likely than not start building up a long position to get price to move up. But we started seeing some indication that that might start happening. But then all of a sudden they closed off a big amount of their longs, all right, from 68 to 49. And ever since then, it just dropped slightly. And then we had the contracts changing over. And they increased longs from 38 to 53, which was decent, but then slowly just fading that long position down to 46. And right now, when you take a look at longs and shorts, we have 46,000 positions long, and we have 46,000 positions short. So basically, they're even. There is no major bias to any direction right now. The coloration of the cells here are blue, so it's neutral. So I still have my orders there because I'm trading this based off market dynamics as I have come to know it. And but before I go ahead and start adding to my position with a secondary entry, I want to see proof that the institutions are starting to buy the Aussie. Okay, and right now things are just very much neutral. Okay, so let's get on to the US dollar. CAD, what do we see? So remember, we saw a huge shift right here, right? After the contracts expired, they switched over to the next contract, but they did not open up as many shorts as they had previously. So they used to have 78,000, and then all of a sudden, boom, 33,000. They only opened short. Okay? So I've come to have a better understanding as to what it is they're doing when they don't open the same amount of positions after the contract expires. There's actually momentum that builds on the charts when they're not opening up the same amount. Okay, because remember, when they open up short positions, price tends to want to drop. Okay, when they open up long positions aggressively, price tends to want to rally. All right, and we'll get into this again on a future webinar. I'm going to explain what I've come to learn about what happens with price when they don't open the same amount of contracts as they previously had. Like when the contract ended right here on March 20th, and they had to switch over to the next contract. Boom, they didn't increase their overall exposure like they had over here, and I'll get into that in the future webinar. But for now, let's just focus on the data. So they're not aggressively short anymore, right? And what have I been saying for some time, ever since this area here, months ago? 1, 2, 3, 4, 5, 6, 7 months ago, I said eventually price is going to break up higher. That's what I said. Okay, and so now a couple weeks ago was the best and first major indication that we see proof that the institutions may be beginning to make that move, because right now we're bouncing up and down, higher time frame demand. We moved up, and now we're testing a monthly area trend line. Price drops, falling short of hitting a weekly area of supply, and now we're coming really close towards this area here, a weekly area of demand, where I am expecting momentum to shift from and start moving to the upside. And what could very easily happen is, we get a move back to test this trend line again, and then the breakout can happen right from there. Okay, and remember, there'll be other traders looking at that trend line, and there might be some smart traders watching to see if that trend line breaks, and it can easily, but it'll be running right into a weekly area of supply, It could even penetrate this area of supply, go even further to this next area of supply here that's nested within this monthly area of supply. And what's going to happen is all those traders going long are going to get suckered into longs, and then this is going to drop again. Okay, so this might be a good long position here. I will consider going long here, even though it's not the cleanest of charts. So because it's not the cleanest of charts and we're in between different areas where price is forcing, where there's a force pushing price in each direction, one from a higher time frame area of demand and the other from a monthly trend line, it's not the ideal scenario to be taking a long position. But if price gets down here and I see momentum starting to shift on the daily chart, and I see more proof that the institutions are buying this pair, then I'm going to seriously consider opening up a long position on this and being very conservative with my targets. Okay, first target would be a test of this trend line again. Second target will be right before this monthly area of supply gets into contact. Okay, so this is something I will be watching for, and it could potentially be a really nice trade, getting in the long down here and bringing it all the way up to here. So we'll have my eye on it. Let's go to the US Swiss franc. What do we see? An increase in longs, which is great. We want to see that. I've been expecting this area to be taken out and for price to come up here and test this trend line. So this is a good sign. Basically, longs are becoming more aggressive, but we also see an increase in shorts, and that comes as this candle of consolidation happens right here. So an increase in shorts, but also an increase in longs. So that basically keeps things stabilized. That 61% overall exposure to the long side. The coloration of the cells are blue, which means neutral, which means it's better not to take any trades on this pair right now. And it's not a good idea to go long with a weekly area of supply and control anyway, so not taking any trades on this one for the time being. Okay, so now we got the euro. And so just like we see what's happening with gold, we see the same thing happening with the US dollar. And what is that? Right? Back here, when price was up here, what did they do? They had 262,000 positions long. Okay. Price drops, price gets back up here, and now they have 221,000 positions long at the same level. Okay. At the same time, shorts were 117,000, but they also dropped to 86,000. 69%, 72%. So again, keeping the overall exposure roughly around the same, because they are artificially maintaining price at these levels. They can't start adding aggressively short, because what's going to happen is they're going to bring in too much supply into the market, and then markets are going to drop. So to maintain price at these highs, instead of adding short, they're closing off their shorts, which maintains the overall exposure at roughly 70%, which maintains price at the highs, which allows them to close off long positions at these highs. Okay? So, so now that we have this move here, let's clean up the charts a little bit right here. We got another move to the downside, but now what we've got here is a weekly trend line. Now in the report that I submitted on the Telegram feed, what I was pointing out was that when we had price back here, one of the things that happened was price dropped, and then all of a sudden there was a really big rally to the upside. And I was making mention of what was happening in the markets and on the news at the time was all this talk about the trade war. So all of a sudden on the news, all this talk about the trade war with China, and what happened was all the traders started selling the US dollar and buying the euro. And that came late into the week, which caused this price movement up. And then when that happened, the next week opened up, and we could see the same thing happening. And I was saying, I'm going to let the market settle, because everybody's going to be watching the news over the weekend, and they're going to come to the markets and they're going to be continuing to buy, because they've been all rattled with their emotions over the weekend listening to the news, and now their first reaction is going to be, hey, we got to sell the US dollar, we got to buy the euro. And that's exactly what happened. So they bought, and then when all those traders' orders were exhausted, the institutions came in and boom, they used that momentum to the upside to reduce long positions. Okay, and then again they reduced shorts to maintain price at the highs. And so that's what's been happening this past week. What did they do? Prices were moving up, and then what did we see? We saw that NFP came out and it was negative NFP data. US dollar, everybody started selling, the euro started going back up again, and it's the same thing over and over again. So they're basically finding another thing to get traders to do exactly what they want them to do. And this time it was a reaction from a weekly trend line that many other traders are watching. Okay, this is an obvious trend line. Price came up, hit the trend, hit this area, made a higher high, created a trend line. Price came, fell short of it, came back, tested it. So now what happens when price hits a trend line? Traders come in and they buy. And then NFP was negative, so it's even more reason to buy. So double confluence to buy here. So now that's what we saw last week. We saw a lot of move to the upside. There's a weaker area of daily demand on the euro chart, which I put out some analysis saying that we should expect a move to the upside from this area. But because this area was a weaker area of demand and it's already been tested, meaning some orders have already been eaten from that area, we should expect this area to be taken out eventually and a bigger move to the downside. So once we get this area here taken out, this weekly area, this trend line here, there's really nothing to stop price from dropping down. Okay, we got this weekly demand area here where last time institutions were here, they added about 6,000 positions, but it's a poor formation and it's expected to be taken out. All right, trend line structure is going to be broken, so a move to the downside is what's going to be expected. It's going to take some time, but I want you to pay attention when you watch the markets today, this week actually. When you watch the euro, I want you to watch how price is going to be played out this week. Okay, taking note of what I just mentioned, but what happened last week and how the institutions are most likely using this to their advantage to push price up here so they could take profits, and then a further move to the downside. Okay, so now let's go over to the pound. Same thing with the pound, just same routine. 99,000, closed them, pushed price back up, and now 99 down to 86,000. And at the same time, 66,000 reduced to 46,000. 60, a slight increase in longs from 60 to 65%. This one's a bit more aggressive. Pound is a bit more aggressive than the euro, that's for sure. It's been holding itself very, very well. Okay, but I'm still expecting a move to the downside regardless. All right, so let's go over to the US dollar, Japanese yen, and I opened up some theme trades to the upside. What is the theme? That the institutions are accumulating a position. Why? Because based on market dynamics, as I have come to know them, this area is an area where the institutions are interested in accumulating a long position on this pair. The only thing that's very tricky here is, again, you know, we had the contracts ending, and instead of bringing long positions back up to the full amount of 123,000, they only brought it up, you know, about halfway, 69,000. Okay, 3 weeks ago, which caused a move down in price. Because think about it. Okay, when a contract ends, you know, we'll get into this in future webinars, you know, how price moves in the markets and what causes price to move up and down the markets. But basically, yeah, we'll get into this on a future webinar, because if I get into it now, we'll be here for quite some time, and I just want to stay focused on the data. But the bottom line is that we're not seeing any signs here yet that they're building up a position to the long side. What we do see is that shorts got somewhat aggressive, but then they became a little less aggressive. But we saw some buying, right? This data here represents this big green candle here, but we're not seeing the buying. So something is going on here. This one has been very, very tricky because as price was dropping this whole time, longs were aggressive, which doesn't make much sense, does it? Price was dropping, longs were aggressive, and shorts were cooled off. So I still haven't quite figured out what has been going on here. I think this could, people buying this pair for other reasons besides speculating on the movement. They say that the yen is a safe haven currency. This could play into why this was so aggressive here. But the bottom line is, based on market dynamics, this should be an area where the institutions will want to start accumulating a position. And we saw that. We came about a pip from my order to go in long, and price pushed up to the upside. And not just that, but we got a nice weekly bullish engulfing right here. All right. So I'm in some long positions based on the institutions accumulating a long position, and I was triggered on another position yesterday off of a 4-hour demand zone. So we'll see this week how that ends up playing out. Okay. Last but not least, we got the Kiwi dollar. What do we see here? Pretty much nothing. They did nothing. Okay. You could see long positions and short positions pretty much doing nothing. But again, after the new contract, they did not bring their short positions to the same amount. And we'll get into my understanding as to why this is happening. Something that I've noticed on the charts, and I'm starting to realize it's the same thing over and over again. Every time they do this, something happens on the charts. Okay, so anyways, they haven't taken any major moves on this. I mean, from 510 to 571, and here from 749 to 948. So it's basically the same thing. There is a slight bias to the upside, with longs being aggressive and shorts being less aggressive, but or cooled off. But the chart is messy. It's finding some support here at that trend line, but a lot of mess. Another trend line here. I'm not taking any trades on this pair. Okay guys, so that's pretty much it. This week we're not going to have any major pieces of data that is coming out to cause any big moves in the markets, but let's watch the euro, let's watch gold, let's watch the US dollar, and let's watch the pound and see how the institutions are going to play this out for the rest of the week. Okay, I told you what my thoughts are from what I've been watching and from my experiences and what I'm seeing in the data, what I think the institutions are doing. So let's see how things unfold for the rest of the week. Okay, so I hope this video was informative and helpful for you to plan any trades that you may take this week, and we'll see you in the community.